I think there is a way to ride this wave, this rally in stacks optimally. There is a way to sell when the momentum is just turning around. Right now we are going up, but at some point in time, right, the rally will stop to a certain degree and then probably the price will deflate somewhat. And in order to figure out when it turns around, statistics can help us. Now what I've done is I've backtested moving averages. I've backtested a strategy where you enter the market whenever the price is above the moving average, so you ride the positive wave, and you exit the market whenever the price falls below the moving average. So what we see over here in this chart is a price with two moving averages, right? The STX price. And these moving averages are not just randomly drawn, these moving averages are backtested. So when we look at the following sheet over here, we see the results of the backtest. So what we have here in green is the result, and what we've got in white is simply just the STX price, the stacks price. And obviously this outperforms buying and holding, otherwise this wouldn't make any sense. And when we look at the logarithmic scale here, right, so this is a 10x with each of those horizontal lines, we can see that during a bull market, the backtest is pretty much in line with just buying and holding, but we do get protection whenever we are falling. And this is in the end where the delta comes from, where the outperformance is coming from. Now, those two moving averages, right, that we see over here, what are they? What's the duration of the moving average? Because you might take, say, the 50-day or the 100-day or the 150-day. What's actually the best moving average to take here for trading stacks? I've backtested several of them, and that's the summary of those backtests. So I've backtested all the way from 1 day, so simply just looking at yesterday's price, all the way to 200-day. And in black, we've got a reference line, buying and holding during the time period, which, by the way, started in October of 2019. Okay, so this is where my data started. Then the first 200 days, we don't trade at all, because that's in order to calculate simply just the moving average on day 200. So the real trading starts in May of 2020. And when we look at the results, the annualized performance, just buying and holding would have given us 150% per annum. But trading, according to the moving averages, in most cases outperforms buying and holding. So note how those lines here are above buying and holding. So it almost doesn't matter so much what kind of a moving average duration you take. You tend to outperform buying and holding with most of them. So we've got two kinds of moving averages here. We've got the simple moving average, that's in green, and we've also got the exponential moving average here in red. Okay, so the best moving average is over here, right? This is where you got the most annualized performance, and that's the 43-day simple moving average and exponential moving average. Interestingly enough, it's the same kind of duration for both moving averages, and this is what we get here for the SMA. And when we scroll further down, this is the result for the EMA. Right? Same thing when we are in a bull market or in a somewhat sideways trading range, we tend to perform in a similar fashion. And then when the bear market hits in, this is when we tend to outperform. So it's really, the idea is we want to determine when do we tend to really go up and when should we rather be cautious and bet potentially on falling prices. And this backtest does assume that you do bet on falling prices. So let's summarize this again, right? When we are here at the chart, we would be long, right? We would be betting on falling prices whenever, on rising prices, whenever the price is above the moving average, and vice versa. Whenever the price goes below the moving average, we would be betting on falling prices. We would make money when the price is falling. Right, so this is the idea. You want to find out what's the best moving average historically. And the reason why I like this strategy so much is that it seems to be pretty robust in many ways. It's robust in terms of what kind of moving average duration you take. So even though the 43-day tends to be the best, it doesn't really matter that much, right? Even if you were to take, say, the 65-day or so, you would still do better than buying and holding. So I like strategies where the parameter itself isn't that important, where you're not just like cherry picking one or two perfect results in order to outperform. If most of the parameters outperform, then you're somewhat on the safe side. So I like this kind of robustness. The second kind of robustness I like is that this strategy tends to work for a lot of cryptocurrencies, not just stacks. So I've backtested many of those cryptocurrencies, and I would say like in 8 out of 10 or so, we tend to see a line like this. We tend to see most moving averages outperforming just buying and holding, and by quite a lot of a margin, right? 150% per annum versus around 500% per annum, right? This is quite a bit, especially when you analyze this, right? When this happens every year with a compound effect, right? This is why on a linear scale, this looks so drastically different. So this is how I would trade this now. When you are already in stacks or you're considering to get into this, you have to watch these two moving averages, the 43-day SMA and EMA. And ideally, you want to put a bit more focus on the EMA because it used to outperform a bit better. So the red line over here. And you want to be selling, or you want to at least consider to take profits whenever the price goes below. So if you're considering to buy now, you should have a stop loss at around 72 cents or so, right? So you do have potential risk of 44% in terms of US dollars until it turns bearish. We would still be bullish if it doesn't fall that low. Now the backtest itself, it looks just at the price at the end of the day. And day means here UTC time zone. So you're not really concerned about crossing these moving averages within the day. You're simply just looking at end of day price. If it's below, then you start betting on falling prices. If it's above the moving average, you continue betting on rising prices. So every midnight UTC, you simply look at the price. If it's above the red line, you continue betting on rising prices, otherwise on falling prices. And currently, unfortunately, we are not that close to the moving averages. So the risk is not that low, right? So the reward might be high. Who knows how long this kind of rally can last, but there is now some risk. So if you simply just continue trading sideways for a while, then the risk will already be reduced because these moving averages get closer again to the price. There are obviously fake outs, right? When we go here in the past, sometimes you might be buying high, right? When we just cross above in order to then sell low again because we are crashing, and the same thing might happen here again. But no strategy is perfect, right? That's why we try to optimize for this. That's why we don't just eyeball the best moving average. That's why we determine this mathematically, right? So in the end, right, historically this works pretty well. It doesn't matter too much that the duration is really perfect. It simply just matters that overall you take those trends seriously, right? The trend is your friend. And this is especially true in crypto. When we've got a bull run, then these kind of bull runs tends to accelerate because they generate more and more attention, and vice versa. When there is a bear market, then we also tend to get acceleration because people panic and because we get forced liquidations as well, right? People simply just exit the falling assets. And so simply go with the flow, right? Go with positive trends and buy in whenever things go up and vice versa. It's not necessarily just because a price is going up that it's already heated and can't go higher. That's the newbie mistake, so to speak, right? When you cut your winners, you can't really make the multiple X investments, right? You have to let your winners ride, so to speak. And you have to only exit when momentum turns around. And this is the way how this can be quantified with moving averages. Now I have done, as I've said, a lot of those kinds of moving averages for many different altcoins. The results of those moving averages are in the premium membership. You can also ask within the Telegram and Discord channel for a new backtest for an altcoin where we don't yet have the best moving averages. So feel free to check that out. The link is in the video description, and looking forward to see you in the next video as well. Bye bye.